Hello ladies and gentlemen, hope you're all well. Welcome to today's review of the True Potential portfolios. So my name's Chris Leyland, I'm the Deputy Chief Investment Officer here at True Potential, and today I'm going to spend the next few minutes talking about our flagship investment product, that is the True Potential portfolio range. Okay, so let's start off by discussing the performance of the portfolios. Then what I want to do is look at the key themes that we're seeing from our fund manager partners, and finally discuss what changes have been made over the month. Okay, so let's look back over the month of July. The portfolios have shown some solid positive returns, with equity markets, particularly in Far Eastern and emerging economies, driving performance. Looking further back, the True Potential portfolios all show double-digit returns since inception, with investors clearly being rewarded for taking risk. Okay, so let's look a little bit more in depth at how the funds have performed that make up the portfolios. And we've seen some strong returns from the True Potential 7IM and the True Potential UBS fund ranges. 7IM's Asian and emerging market exposure, but also their alternative positioning, particularly in the market neutral space, have really helped to drive performance over the month. The True Potential UBS fund range continues to go from strength to strength, with another solid set of performance figures helping to build on the strong numbers that we saw earlier in the year. Okay, so moving on, as you know, we speak to our fund manager partners at least monthly. And what we're looking for, we're looking to find key themes and then tilt the portfolios towards these key themes in order to take advantage of them. So overall, in general, our managers are cautiously optimistic around market conditions. They take the view that while we may shortly come to the end of a loose monetary policy environment, they do not see a catalyst for equity markets to derail. They're cognizant that valuations are pricing securities at high levels by historic standards, but take the view that a downward correction would be a buying opportunity, with the cash available and sitting on the sidelines. Moving on to UK interest rates, none of our manager partners right now see interest rates rising this year within the UK. Okay, so let's move on to trading that's taken place within the portfolios over the month. We've carried out a number of changes this month. They lie within our cautious, balanced growth, cautious plus, growth plus, cautious income and balanced income portfolios. Over the month, allocations have been increased to the manager stars of Allianz, Goldman Sachs, Schroeders and UBS, whilst SCI, Schroeder and Columbia Threadneedle have been reduced. Okay, so let's start off with Allianz. Their allocation has been increased because of their ability to be very nimble, reacting quickly to changes within markets. Also, they've taken risk levels down with the introduction of an absolute return strategy within our funds, and their current low risk positioning also acts as a hedge within the portfolios should there be any short-term volatility. Okay, so let's move on to Goldman Sachs. So the allocation towards the True Potential Goldman Sachs Income Builder Fund has been increased. And that's because of Goldman's ability to source income from both traditional and non-traditional areas. Their fully currency hedge positioning also helps guard against the risk of sterling starting to rise. We're also attracted by their ability to select securities on fundamental considerations, and this has been working well. Moving on to Schroeders, their allocation's been increased, and this is due to their excellent stock picking ability that's really shined through this year, and also their managed exposure to sterling helps to mitigate negative currency moves. As we progress through the market cycle, and with most asset prices having risen, stock selection becomes a more important way of separating winners from future losers. Their fundamental and technical screening criteria, alongside a stop loss discipline, will assist them to navigate changing market conditions. Next, let's talk about UBS. Their core portfolio approach has driven consistent returns across the risk spectrum, and this is why we've increased their allocation within the portfolios. This is fulfilled by injecting the same core portfolio construction into each fund, but with a futures overlay being used to buy more risk assets and government bonds being deployed to dial down on risk. The benefit as well of having an active currency strategy fund, what they call CARS, within the mix has also produced good returns. The currency strategy is also a good way to add diversification. Okay, so let's move on to SEI. So action has been taken to reduce a significantly overweight position, but one that has actually worked very well for us. SEI's bond component is higher duration compared to our other managers, albeit lower than bond index benchmarks. And what that means is their fixed income assets are more sensitive to changes in interest rates compared to our other managers. SEI are also transitioning their manager style emphasis away from value because it's hindered their short-term performance. They are shifting towards momentum and event-driven, which will take a little while to implement. Meantime, however, they continue to offer an extremely attractive and well-diversified manager of managers proposition at an attractive cost. Moving on to Schroeders, the True Potential Schroeder Balance Fund has been reduced within the models, and that's helped to reduce down the overall cost of the portfolios. Their fund of funds approach is higher cost, but they're aiming to deliver higher returns through the cycle by emphasizing capital preservation at points when asset prices are elevated. We're currently finding that a number of our managers have been dialing back on risk, which allows us to be a little less reliant on our funds managed by Schroeders. This has the added benefit of us shedding some cost across the models. Threadneedle, the position has been reduced, moving exposure from UK asset selection to security selection that is geographically more diverse, and that's at a time when UK economic data is slightly softening. Looking at the rest of the True Potential portfolio range, allocations have been kept the same, with the optimization of factors continuing to be paramount within the portfolios. Thank you very much for listening, and I will speak to you next time. Thank you.